Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, May 15th, 2020. What we're going to do in this video, we'll mix things up a little bit, cover some charts and some indicators, mainly some breadth indicators, things we haven't covered in a little bit. A lot of what I do is the same old, focusing on these, what I don't want to call micro levels, but more near term, shorter term stuff. Micro levels are really, 5, 15-minute charts. But lately I've been really focused on the 60-minute charts. And again, if you take a look at the bigger picture, you go to the daily charts, turn all the lines off, you're grinding around. So I do talk on the fact the daily charts have run up to those, the broad market, the S&P 500 has run up and made several attempts to break through or test the 200-day with the recent failure. 61.8 Fibonacci retracement also came in perfectly, as well as some price resistance. So that's kind of the daily chart. And then to gauge kind of the near-term direction when you're in a trading range like this, it really does no good to put most of your focus on the long-term charts, the daily and weekly and monthly charts. I do like to keep an eye on those, so from time to time I'm going to touch on them. So let's just start out with the near-term outlook, and then we're going to change gears and look at some kind of zoom back out to the bigger picture, but instead of focusing on those same things I've talked about recently, like the bearish engulfing candlesticks on the indexes, which were confirmed this week after they were put in, confirmed with more downside, the failures at the 200-day moving average, the failures at the 50 or 61.8 fibs, the back test of the 20-month exponential moving average on the long-term monthly charts. We're going to look at some breadth indicators. All right, so this is SPY. Before we get into that, just kind of an update, because I do think it's important, the levels to watch. And these same levels have been highlighted the last couple days, about 284 or so on SPY. It was support on the way down. Remember, we had a gap there. Quite a lot of reactions on that level. We broke it the other day. Pop back up with a brief momentum fueled overshoot. In other words, we got a lot of upward momentum heading into that. One candle closed above, and that was kind of, you can see too, that marked the close that day. That's that late day selling. You kind of get order imbalances as mutual funds and ETFs all in the last minute of trading, last couple minutes, scramble to square off their positions. Mutual fund redemptions are met at the end of the business day. That's where you get the price if you sell or buy a mutual fund. And then ETFs have to balance out their holdings. If you're SPY running, if you're the company that runs SPY, then you have to kind of match all those positions, those 500 stocks within there, to the the value of the ETF. And so that's why you always get those kind of, here you can see it here, kind of sharp rips and dips, usually into the final minutes of trading. Usually you don't see a flat line out, 30 minutes into trading a flat line. You're either going to get a rip, and those rips usually come on days where you already have upward momentum heading into the close. And likewise, when you're going down, just like here, you can see the daybreak lines right here. You tend to slide into the close there. So that's what's what happened yesterday. And again, you can zoom in real tight and see there's yesterday's close, and we pop right back down there. So again, sometimes you have to take certain moves in the charts with a little bit of grain of salt. And one of those is, and I talk about this often, I don't take breakouts that occur in the final minutes of trading, usually in the last half hour of trading, whether it's a breakout to the downside, a short a sell signal for a short trade, or a buy signal for a long, because of what I just talked about. Those tend to be, you need to discount that a little bit and take any of those last minute moves with a grain of salt, because of the end of day positioning. So here's where we picked up today. 60-minute close, you can see rallied up. That first 60-minute candle failed there. Next one tried to pop it intraday, tested yesterday's high, and then boom, back down below and back down below again. So what am I saying? Basically, this is simply a breakdown and a back test of resistance, and so far a failure there. And now, so it would be bullish to see a solid 60-minute close above this level. And again, we'll just round up. It says 283.90. We'll call it. You can call it that. You can call it 284. We also have two reaction highs there now. So any solid break above that level would certainly be a near-term bullish technical event if confirmed by the other indexes like QQQ and the Dow. Remember, sometimes you have one index breakout and then the other one at the same time. SPY's breaking out, QQQ runs into resistance, and then that can cause a false breakdown in SPY. As of now, nothing's changed. That's what I favor. Again, these pops that we had in the indexes were not random or arbitrary. They were telegraphed in advance. There are no guarantees, but these 60-minute divergences, as they so often do, did play out for a bounce. It's a positive bullish divergence with these indicators making lower highs. The market's fallen to support with bullish divergences in place, and it led to what I refer to as a tradable rally. Tradable if you're an active trader. That's about a 4% lift in ES, 3.7 or so. Certainly, if you're trading futures, leverage contracts like that, actively trading, you'll take that all day long and then some. In some markets, it can take you a week or even a month or more to make 3.5% on ES for the broad market. And with volatility picking up once again, you can get that in just a day or two now. So that's a good thing. Now, while we're on this chart, we'll look at the levels that I'm watching. Again, last night we put in a small, or yesterday's highs, I should say, small divergent high on the RSI down here, not really on the PPO, but that's all it took. And again, so here's $1 million question: is that 3-4% rally enough to satisfy these divergences? Certainly, absolutely enough, especially if we are still in a downtrend, more so. If it's not a downtrend, if this is just kind of noise within this trading range and the markets want to make another run at or above the all-time, those previous highs, I should say, then yeah, we can get another leg up. So while I can't ever guarantee where we're going, I don't think we are. I don't think that's the case. I made a case this morning. We're in a near-term downtrend, series of higher highs, higher lows. I'm sorry, lower highs and lower lows. Let me speak more clearly on that. That's it. That's your series of lower highs. And again, it really starts back here. The bigger picture is 1, 2, that high, previous high, and then we call it this high or this high, and then these two lows right here. So lower lows, lower highs from that kind of bigger picture trend right there. Still not the long term, or even more of the intermediate trend right there. And then you also have, as I highlighted this morning, using different color codes. If you look at these highs here, this is just a shorter term downtrend right here. There's your lower lows, lower highs, and it kind of looks like this. You can't really draw a perfect price channel, nor do you have to. Trends aren't always, you can see here, they're not always defined by perfectly parallel price channels, but most important is that series of higher or lower highs and lower lows. And plain and simply, if they take this one out, well, sure, is that going to call that near-term downtrend into question? Absolutely. If they take this one out, it's going to call it into question even more and just kind of really muddle up the charts. It's possible. It wouldn't surprise me. Remember, the bigger picture is this. When you're in a sideways, bigger, larger sideways trading range, you can get these kind of what I call micro trends and, trade them accordingly. And as of now, what we want to look for is what is the next move. Are we going to take out this high or yesterday's lows? Obviously, goes well, as I just said, that would be near-term bullish, whereas that would be near-term bearish. So that's what I'm looking for. And on NQ, you have almost an identical thing, except the trend started a little later. NQ's been holding up, because it's mostly tech stocks, holding up better than the S&P 500. But there's your downtrend, your higher or your lower highs and lower lows so far. So same story. Bulls want to see this level popped right here. Bears want to see this level popped right here. You guys know which way I'm leaning because of everything I've talked about for days now, and that is to there. It's not a straight shot down. I draw these arrows like I did this morning, but so just kind of micro levels to watch. We had let me clear all these lines out. Micro levels are this line here. Remember, that was that high right when I was doing yesterday's video. First the S&P 500 futures popped that comparable level. What am I talking about? Let me just flip back to it. That was right here. So I said, okay, there's that breakout in ES, and it was impulsive. And right towards the end of the video, I said, well, to confirm that, NQ would have to break out as well. And then right after I wrapped up the video, that's what happened. So that was a breakout. That was that late day lift that occurred after the video, because that's a clear, and you can see it was impulsive. It wasn't a random level. There was a lot of reactions there. And so once NQ cleared that comparable resistance, meaning the comparable to ES, those reaction highs right there, it ran, And again, it came kind of full circle. The divergences have played out now, so they've been satisfied at least to the minimum, of what they would project to. So kind of get that out of the way now. Those are the levels to watch. Oh, and of course these lines, that was color coded, very important line on NQ and still is. And you can see that's where we pulled back to this morning, had to bounce right back up to that same line. That was that line yesterday that we popped, and that's where we failed. So kind of micro levels, if you're a really an active trader, or even a swing trader trying to wonder which way we go next. Well, that's it. You have that level we popped yesterday. It was certainly validated when you had the impulsive breakout above it, back tested, and then failed at today. So this is it. Bing, bing, bing. Bouncing, ping-ponging right now between support around roughly 89.55 or so, and then that high. Should we pop that level? Yeah, you have this high to contend with just above that 91.12-ish level there. And, for the bear case, you need to take out yesterday's lows. And I know a lot of you don't trade futures, so comparable levels on QQQ is about 220.55 roughly. That's some price resistance right there. And so this is it. We had this smaller wedge breakdown following the larger wedge breakdown recently. Impulsive move down, kickback rally to resistance, and same story. We need to take out those previous lows, to give a check mark for the bearish case, open the door to more downside, whereas the bulls want to see this previous high taken out. And they still have work to do, but again, that sort of certainly puts a damper on the near-term bearish case if that happens, but it doesn't eliminate it. You still have these trend indicators that flipped to bearish recently on SPY and QQQ. I'm talking about the PPO signal line down, crossing below that purple line there, just below the zero line, other things like that. All right, now let's take a look at some breadth indicators, and which will really help paint the bigger picture and the underlying health of the market. That's kind of what I want to get at. Okay, in no particular order, we'll look at some of the market internals, and again, that's kind of how to diagnose the health of the market when you lift up the hood. It's like a mechanic. You take your car into the shop. It might seem to be running fine, but your mechanic says, hey, wow, you've got this or that. Your timing belt is about to fail. You've got 85,000 miles on your car. That should be replaced at 70,000, and that can snap at any time. It's brittle, and if it does, your car doesn't run anymore. Those of you that had a timing belt or go in the past, that's your car goes kaput. So that's the market internals. You look under the hood because everything might seem fine at first, and and that's what I want to talk on about how the QQQ and NASDAQ 100 is not far off the all-time highs after a tremendous rally. SPY still has a way to go, but still an impressive rally. So now let's take a look under the hood and see what all that means. Now, so we're looking at this first indicator, and this is the NAHL on stockcharts.com. You might be able to pull this indicator on some other charting platforms, and that is the NASDAQ new highs, new lows. Now I'm going to start out here with the NASDAQ. We'll look at the S&P 500. And again, the NASDAQ, and we're looking at the NASDAQ composite. That's all, thousands of stocks. We also, most of the indicators will, like this, will look at the NASDAQ, and in some cases, we'll look at the NASDAQ 100 again. The NASDAQ 100, which is the NDX, or QQQ is the trading ETF, tracking ETF for that. Those are the 100 largest companies within there. And so when we look at the NASDAQ, what we can see is, this is a chart I've had for years now, and I've shared on the sites many times. You're looking at the last cycle, the last few bull and bear markets. Going back in time here, you have this box here. It may not look like much to you, but that's the Great Recession back in from the 2007 highs. Market topped in October 2007, bottom in March of 2009. And that was a 55%, roughly 55% drop in both the NASDAQ and the S&P 500. So one of the biggest bear markets that we've had, especially in recent years. And it was pretty clearly telegraphed by the NAHL, at least by this indicator. You can see what I've had here is a trend line, a very well-defined trend line that formed during the previous bull market leading up to that. We had a bull market here. It started in late 2002, and it wasn't the most powerful, but it was a solid and steady and a clear bull market, and that ended again in October 2007. And what happened? Well, this dash line right here marks that top right here. We'll zoom down. You can see it. There's the end of the bull market, and a perfect sell signal via the NAHL breaking down that clean uptrend line right there. Again, the uptrend line that once that bull market came off the lows, after the lows, you see a surge up in the stocks. Making new highs compared to those making new lows. That's part of it. And then you get in a bull market that kind of normalizes, and you get that you have corrections along the way, but more of a steady up. And you can see very well defined, a lot of pullbacks to that level, and boom. So that's number one. Number two is I throw up a 20 period exponential moving average on there. So if you really were to zoom in tight on this, I can't expand this chart, but it would show you that the NAHL is the black line and the red line's a 20-month exponential moving average. And I like to use that 20 EMA when it crosses above the NAHL, that's a bullish signal, and when it crosses below, it's bearish. Now, since you can't see it, you might wonder why I'm talking about it here. Well, I created a custom indicator down here using a MACD, playing around with the settings, that will show me visually, give you a visual representation of when the lines cross. In other words, when the histogram crosses the zero line, the flat line right here, that means the lines have crossed. And so it does a pretty good job. You'd have to pause this video and zoom it in, and you can see it does a pretty good job. These red lines are sell signals when you have the bearish crosses. So when you had the breakdown there, you also had a sell signal with the two lines crossing over. Not only did the NAHL break the trend line, but you had the bearish cross between the two. In other words, the 20 period exponential moving average cross down below. And then you can see we set up in one of the greatest and longest bull markets in history after that last bear ended in March of 09, and we had a very well defined uptrend line with the NAHL, meaning we're in a bull market. Over time, there's ebbs and flows within the bull, but you had more and more stocks making new highs versus new lows. That's part of a bull market. And then finally, recently, and for the first time, it coincided with this bear market that started back in February. We had a solid, clear, unmistakable breakdown, again, of a very well-defined trend line. So what is all this about? Well, it helps to support the case that a new bear market has started, and then what I've been saying, that despite the strength of the rally and the apparent bullishness to many, it's just at this point in time, most long-term indicators say, hey, you're in a bear market, so it's probably a bear market rally, despite the recent bullish price action. That's just part of any bear market rally. It'll make you second guess the fact that you're even in a bear market because price action is so bullish and strong. All right, so that's that. Also had a recent sell signal there, and you can see. Another point. I talked about how that histogram does a good job of it shows you when the NAHL is trading above or below the 20 period exponential moving average. So that red line was also a sell signal before the breakdown even occurred. Would have got you in a little early, and it was the last sell signal since right here. These are pretty darn good sell signals. You can see. I take that back. There was a few whipsaws in here, but it caught most of that big drop in the end of 2018, the fourth quarter right there, with an early sell signal early on, and then a buy signal when it was over to get you out right there. And again, sell signal there. And what I wanted to point out right now is the lines look like they were going to cross, and in fact they did. And this is what you're seeing on the right margin here is a zoom in feature on stock charts. You can zoom into the chart so you can see the detail a little better. So this histogram shows you a single day whipsaw, 1 day cross, but which has really so far just been a rejection because we went back down below. In other words, the 20 period moving average exponential moving average is now back below after only crossing above 1 day. So I'll watch this. If we continue to move lower, then that would be just a kiss or a back test of lines, and that's not unusual when you're in a downtrend to have these trend indicators come and kiss. In other words, look like they're about to cross over, and if they do, great, because that's nothing but bullish, at least near term. But what's even worse is when they come up, they look like they're going to cross, or they briefly cross and then they get rejected. You get what I call a kiss. They kiss, the two lines kiss, and then boom, get a rejection. So that's something I'm watching for. And being the fact we're below it now, and much more importantly, well below the primary, the uptrend line there. That's this by this one metric. And again, we're looking at breadth now, not market price, not stock prices, but the underlying internals of the market, and that is not good. That is bearish. Well, here's one I've shared in the past, even recently, so I don't want to spend too much time on it. This shows the NAA 200R, which is the NASDAQ percent of stocks above their 200-day moving average. And, it's the same kind of stuff. You can use these breadth indicators to look for divergences. There was the last bull market, the top NASDAQ composite was moving higher, but the number of stocks trading above their 200-day moving average was falling. What is that indicative of? It's the FAANGs. It's the big, beloved, huge, multi-billion, close to 800, 900 billion, or even $1 trillion more as of this bull market cap companies. And it means just fewer and fewer stocks. That's what it's telling you. When the stock market, the index is rising, but yet more and more stocks are falling below their 200-day, it tells you that fewer and fewer are doing the heavy lifting. And again, it's that whole analogy, something your car might be running, everything seems like it's fine, but there's something wrong that's about to break with the engine, and that's what happened. So that was it was foreshadowed the bear market, that 55% drop that came, and even along the way throughout the bull market. I've highlighted these. We get these divergences, they build, and they play out for corrections. 19%, 20%, 11%, 18%, 22%, 30 or so percent so far. And again, this was a big one here. These were multi-year divergences, and it's not as if the little ones didn't play out. The little ones did play out for corrections along the way, but we kept diverging. And where we're at now is, you can see this is kind of trending lower, and that's more of that's not a good thing. Early on in a bull market, you can see these lines kind of bottom here, and you have higher lows against the percent of stocks trading above their 200-day moving average. So that's one to look at. Here's another one. This is the NASDAQ composite again, with the compared to the percent of stocks above their 200-day moving average, just a different variation. Here's the last bear market, and you can see, when what I have down here, I should make clear that this line right here is the 200-day moving average. And again, so up top, it's showing you the percentage of stocks above their 200 days. So early on in the bull back in 03. Early on in the market, you had a very high ratio, over 80, well over 80, almost 90% of the stocks trading above their 200-day, just like at the end of the bull market, or bear market, I should say, you had only about 10% or so. You can see the scaling over here. And so this is the halfway point. Where 50% of their stocks are above, 50% are below their 200-day moving average. And so I look at things like this, and what stands out, I could really sit here and talk on this chart for 5 minutes, and I've done this, studied it extensively in other points, but usually when you come back up in a bull market, when you've crossed back above the 200-day, after a correction, normally at that point, you have the majority of their stocks back above or near that level there. In other words, there's the 50% mark. That 50 means half, 50% of the stocks trading above their moving average, and that's usually what you'll see once or shortly after the NASDAQ composite, which is down here, gets back above the 200-day. You can see this time around we're way above the 200-day moving average. We haven't seen, and what's unusual, so we're well above it. Yet, look where we're at. Only 35%, or actually 33% of the stocks in the NASDAQ composite are trading above their 200-day. Yet, when you look at the NASDAQ composite itself, maybe you can see it now that I zoomed in. Here's a 200-day way down here. Again, this is a little zoom right here. So you're way above there, but yet only 35%, or 33, I'm sorry, 1/3 of the stocks are trading above that. What does that tell us? Again, everything I've been talking about, that it just fewer and fewer stocks are doing the heavy lifting. You say, what's wrong with that? Well, again, what's going on, especially with the Nasdaq 100. And I talk about it again, the Nasdaq 100 not being the stock market, but it is an index a lot of people watch. It's really a sleight of hand, if you will. By that I mean you look at the Nasdaq 100. You look at where it's at. Again, here's rolling back. There's the all-time high right there. So we're within, or the other day we came within, 3.5% of the all-time highs. So you're like, wow, it's nothing but good. Well, one way to illustrate the point that I've been making, that it's just a handful of stocks because of the big weighting. So where I'm going here is the Nasdaq 100 is a market cap weighted index, meaning it gives a bigger weighting to the largest cap components and a lower weighting to the performance index on the other ones. The S&P 500 is also a market cap weighted index. However, they don't apply as large a weighting. It's adjusted downwards, so they don't give such a heavy weighting to the top components, even though they share a lot of the top components. So I'm using this example because it magnifies the effect a little bit more, but that effect is also in play on the S&P 500. Okay, what am I talking about? All right, to get to the point here, here we go. So there's the Nasdaq 100. What I'm going to do is sort these are the components right here, all 100 stocks. It says 103, and that's because you have couple different companies have different share classes. You'll have a Class A or a Class B. So what I'll do is I'll sort it by market cap. So that's going to give us our big boys. This is what I've called the FAANG stocks, FAAMG, right here. And that's, you can see why Facebook, Apple, Amazon, Microsoft, and Alphabet, they're two share classes. So that's one example why you have, more than 100 in the watch list, but they're really 100 companies, just different share classes on 3 of them. All right, so what we're going to look at is how these guys are doing. All right, so there's Microsoft. Let me zoom in a little tighter. There's our all-time high, and there's Microsoft. Came really close, within 1.5%. I'll just rifle through the rest. Apple, again, close to all-time highs on this rally. Amazon made new all-time highs since the top back in February. Alphabet, still not there, but not too far off it compared to a lot of other things out there. And there's Facebook, and that's almost an all-time high, close enough. Intel, kind of there. Now you go down the list and you start to get, and there's Netflix, by the way, and that's right behind. That's about the 7th or so largest component in NVIDIA. So we'll stop here. So I just went through, at least by market cap weighted or market capitalization, the about the 7 or 8 largest companies within the Nasdaq 100. Now what I'm going to do is click on this sort list to show you the smallest companies within the Nasdaq 100. They're still big companies. Here's Baidu at the bottom of the list at about 3.3 billion. And now we're going to look and see, and it'll show you really what's under the hood in the market. Again, we're looking at a daily chart. You can see the scale. The year breaks below. Here's the beginning of 2019, beginning of 2020. So I'm just going to rifle through the same thing, like the top 7 or 8. United is number 2 at about 5.1 billion. Here's a stock pushing 52-week or multi-year lows. Expedia way off the highs. Point is, these stocks are clearly in a bear market. Many of them started a bear market back in 2018. So this is what we call market internals. This is what the market looks like under the hood. But again, there's a facade almost, or like I said, a sleight of hand. When you look at the Nasdaq 100, you think, man, tech's doing strong, the market's strong. No, a few handful of companies, and for whatever reason, we can sit here and debate all day long. Look, they're great companies, I'll give them that. They're earnings juggernauts, they're well managed, but because of their enormous size, and whatever factors to be, part of that is they're very cash rich. They buy back a lot of their stock, which further, that's another financial engineering gimmick to raises the stock price. And at the end of the day, if you invest in them, great. But it is a dangerous thing when we see that, because again, you might be saying, well, Randy, why don't I just buy the FAANGs? They're great companies, they're going to continue to go up. No, time and time shows, as I started early in the video, when you see these divergences, and they can take months or even years to build, when you see fewer and fewer stocks going up when the market is rising, almost inevitably you are going to have a major turn in the market, a major correction or a bear market, and that's happened in just about every other cycle in the past. You can go back and check those charts, look at breadth indicators yourself. You'll see the same thing as I pointed out, those divergences among whether you're looking at the percent of stocks above their 50-day, their 200-day moving average, when you're looking at the number of new highs to new lows. There's a lot of different ways to look at market internals and breadth. But you can see as I've gone down the line here, the point I'm trying to make is pretty consistent. And I'm not skipping out. I'm just going in order now, the lowest weighted, components, and they're all still solidly entrenched in bear markets without any exceptions. So as you get down the line, if I keep doing this and I get back up towards the top of the list, you see more and more money. So that's where money's been concentrating into those stocks, and ultimately what happens, they end up collapsing under their own weight, because it's simple. If the majority of stocks are in bear markets and they continue to fall, it's showing you what's going on in the true economy, and people aren't pricing in right now the fact that stocks are going down, reflecting a recession or earnings contractions, and that will eventually spill over to those big cap names, no matter how well they're run, because those are cyclical companies. They're subject to the business cycle. Consumer spending accounts for about 70. I've seen anywhere from 66, 70% of gross domestic product, GDP, and the consumer right now isn't working. We're seeing unemployment skyrocketing, everything else. So it's just a matter of time. And again, these things take time to play out. Divergences can extend for a while. You can have these breadth divergences, internal deterioration in the internals that go on for some time. But I just want to do this video to kind of spin things in a little bit different light. Take a look at something different than just price action, as we've been doing recently. Okay, and to wrap it up here, that's it. We need to see those market leaders break, and probably cover those in another video. But one proxy, you can look at XLK. It doesn't have Amazon and Alphabet in there. So you look at XLK and XLC. Those two alone cover the FAAMGs right there. They put some of them in this one, but they both have the same bearish engulfing candles, just like the market right here on a Tuesday. Followed through red candles, and here's XLC kind of flirting with the 200-day, and then XLK. So if you really want to just track two sectors to kind of get the best proxy for the market, it's these guys. So there's our sell signals on Tuesday on XLK on tech, follow through red candles. These tend to be pretty powerful and often lasting sell signals, and so that's what we need to do. For the bearish case, XLK needs to stay below here and really start moving down up until you get these FAAMGs breaking down. It's going to be hard to see the market going much lower because of their enormous weighting on the indexes. And so you have, let me just go back here to said I'd wrap it up, but let me just go back to Microsoft 60-minute charts and things to watch, trend lines and support levels. I'll just rifle through and you can see the levels and what these stocks need to do. They all have the divergent highs. Most have broken down recently, but have hit some support levels, like Apple. Here's a big one, broke below the bearish rising wedge, dancing on 302.24 support, basically the recent lows, just like I said with the markets. You need to take out yesterday's lows to open the door to the next wave down, and unless that happens, like I like to say, support is support unless broken. So that's what we need to get. Big level there on Amazon, down to about 22.80. I'll color code that, since that should certainly be one to watch if you want to set a price alert. That should start a nice leg down if and when Amazon takes that out. Alphabet kind of flirting with this secondary benefit of the doubt trend line right there, so you can replicate that. Comes off the March 23rd lows. Same thing on the other share class, GOG. We're going to stretch it down here and we'll just cover that. Come and catch this reaction low. So this one's flirting right now with trendline resistance, support I should say. And so again, it's the same story. If we can just take out yesterday's lows in the markets, it should take a lot of these FAAMGs that haven't yet broken down, like Apple. And Apple again has that support just below. It needs to take out as well. And then one more level I'm going to give you for Alphabet right about there. Needs to take that out as well. And that's it. Facebook, see, same story. These guys are flirting with key uptrend line support. Some have cracked the uptrend lines, but then have that horizontal price support below. So it feels like you just need that little nudge now, about another 1-2%, or more downside in the markets should do the trick. Until then, it's hard to get really aggressively short. And if you're long, and I'll tell you, be quite bullish if the markets can pull a rabbit out of their hat and come on up and take out the recent highs and hold these levels, especially if they can burn through all these divergences that have been put in place recently by burning through, taking out those divergences, moving these indicators up beyond those previous highs, so you no longer have the negative divergence. That could set the stage for some type of blow off rally, blow off top, or just rally. Let's just call it a rally, whether it takes the market to new highs or not. And this in reverse could cause a waterfall type sell-off if these levels all start to go. And once the majority of market participants realize those support levels on these market-leading stocks have been broken. We will wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.